Let's take the discussion on markets forward with Jaspreet Singh joining us now. Jaspreet, how are you really approaching what's your framework in this kind of a market for portfolio selection? Before we talk about the stocks which you like or the kind of trends you have in your portfolio, what is your selection process?
Hey Ajay, thanks for inviting us. Good to be back. So, our selection process, we basically divide our, concentrated portfolio that we have of about 24, 25 stocks across three buckets. So it is, the SG, MO and SO. So what we mean by that is the structural growth stories that comes under the first bucket, that the long-term compounding stories. The MO is the momentum opportunities, which we take with a 2 to 3 year view, and special opportunity SO, which is where we take investments with a 1 year view. So we would have the three buckets: 1 year, 3 year, and 5 years. Accordingly, we would have stocks spread out those 24. Coming to the themes, given what the recent disruptions have been in India, like COVID, like GST, demon, etc., even earlier, given that, and the way the new things are evolving with the earlier Gen Y and now Gen Z occupying the larger part of the ecosystem. What I mean by that is the new age entrepreneurs, the new age clients, the ecosystem, government also promoting startups. So there are three themes that we are largely concentrating our portfolios around. The first is the formalization of economy, or the unorganized to organized, where the top 5, top 4 are taking the lion's share of each sector. Second is the higher use of technology in each and everything that we do, and including digitalization. You wouldn't have thought of opening a demat account in 2019, sitting at home, and you look at what's happened last year, right? And last is the financialization of savings. So I think there are more, but these are the larger set of themes that we are encompassing our stocks and our portfolios around. Ajay?
Right. Jaspreet, I also see some top class steel companies in your portfolio. We understand last 3-4 weeks the prices are stable to negative. What are your thoughts there? Is it a temporary or transitory correction which is taking place in your view, and the steel story remains intact?
Absolutely, Ajay. So steel cycle, metal cycle, typically they take about 3 to 5 years when the bull market or the positive trajectory starts. The last big one being 2003 and 2008, which was a good 5-year cycle. But this time around, even if it's just a year that it started, let's say, let's not take August, let's not take March or April. Even if it means August 20 to August 21, it's just been a year. So, given the fact that you have so much of production curbs in China, which is the single largest producer of steel and metals, the coking coal prices are so high, and they have put curbs on exports. So what it's leading to is so much of supply tightness, which means that the demand growth being at 6% or more growth globally, and Europe growing at 10% or more, it looks like that steel prices are there to stay, or maybe marginally higher. And remember, the domestic steel prices are still at a 10, 15, 20% discount to the international prices, depending on grade to grade and category to category. So there is room for further expansion in domestic prices, and the current EBITDA estimates of the street, including us, is still not taking into account the current steel prices. It estimates that there would be a certain softness. While if the reverse were to be true, that the current prices were to sustain for the balance part of the year, I mean, most of these steel companies would be, including the largest steel company that we have in our portfolio, Tata Steel, would be the debt EBITDA would go down to as much as 1 time, versus 2 times, which it was 2 quarters back, and even further lower thereafter. Just a disclaimer: some of the stocks that we will be discussing, including Tata Steel, we would have a vested interest, as in it would be held in our client's portfolio.
Right. Jaspreet, I also see you have some new age food tech companies in your portfolio, recently listed ones. Not a call on them, but on the one hand, people are excited on the street and investors are looking forward to car trades, Nykas of the world also to join in the party with Zomato. On the other hand, there's a large section of old investors which are building positions in Easy Trips, Angel One, some of the other technology platform companies like exchanges, BSE, IEX, MCX. What are your thoughts on both these two? These are also technology-enabled platforms, and the new age ones are also technology-enabled, consumer tech companies. What are your thoughts here?
Yeah, so we're positive on this space, and as I said, what's happening is in this entire ecosystem where the earlier it was Gen X and now Gen Y, which is the Indians born or people born after 1980, and the Gen Z, which is now people born after 96. They are the large part of the ecosystem which is driving this. By that I mean the consumers, the people in the technology, and because of this, things which are not possible earlier, or people thought that it's not easy to start a business in a year's time, and you see in COVID how many businesses have started in calendar year 2020 and how many actually have thrived in that period. So we are positive on this space, and the holding that we have so far is our two stocks. One is Zomato and one is IRCTC, which we have in our clients' portfolios, and we are very positive on these two, specifically Zomato, because the opportunity is so huge even in the food delivery business, and leave alone what more that the company can do in terms of cross-selling, given the amount of huge data that they have today and what they will end up in the next couple of years. So the strong network effect, stickiness, customers, the restaurant partners, tie-ups, inorganic growth opportunity because of the huge fundraise, cash bank balance that they have after the IPO. And remember, it's a duopoly. So I mean, today, if you were to decide where to order, you don't have a third option. I mean, literally. So it's a huge market with a duopoly, and Zomato being right up there in terms of growing 30-40% or more compounded year after year for the next many years. So I guess it's a huge opportunity, and so is the case with a company like IRCTC as well. We consider it as a platform business because obviously it's just not a railway ticketing business. They are trying to venture into other parallel businesses like a hotel, a tourism, and bus booking, and even airlines. And again, large amount of other parallel opportunities available given the data that they have built over the many decades of Indians who would have traveled using Indian railways in the last many years.
You understand cement space, right? Jaspreet, you understand cement very well. You have JK Cement in your portfolio. I want to understand, in your view, across mid, small, large, what kind of earnings growth, which name does offer best earnings growth for next 3-4 years structurally, and is valuation wise also risk reward is attractive in your view?
No, that's a very interesting question. So yeah, I mean, in the large cap, what we like and what we prefer to have holding for some time now is Ultratech, and in the mid cap it is JK Cement. And the common theme that runs through these two companies is one, top-notch management, the hunger for growth. Both of them have been having expansion plans, have been growing in the last 5 years, have huge expansion plans for the next 5 years. The EBITDA margins are good, high, sticky. They have other businesses than the grey cement, which means they would have white cement, would be businesses. And you look at the last 4 quarters performance, you look at the last 4 years performance, it's been very rock solid and steady. And the return ratios, can't ask for more. Both of them are closer to 20% or more return on capital, return on equity, while ensuring that the balance sheet remains as light as possible. So put everything together, and you may not have the cheapest of valuation, but I guess that's what the market has taught us in the last, in the period between 2019 and some part of some part of 18, that the companies like these, like Ultratech, JK Cement, given the way they have been throwing huge cash, continuous, using the same cash back in business to generate return on capital anywhere between 15 and 25%, does yield to good long-term compounding, and both of them have been a good compounders in the recent years, specifically JK Cement. So I would say, yeah, these top two picks, JK Cement and Ultratech, and let's not forget that there are sector elements. It's a large part of the material stroke building material space on which we are positive. So we would be positive on, let's say, real estate and building material, and therefore it's another way of playing that sector.
Right, clearly. Thanks very much for your thoughts, Jaspreet. Great chatting with you. We'll take a short